So firstly, thanks for inviting me back. So I founded JDI Research about 5 years ago now. And what we try to provide is a wide array of clients with a strong and accurate global macro outlook to feed into a top-down strategy for whatever investment process they might be trading. So I also have a unique 20-year experience in both portfolio management and strategy, which I think enables me to connect the dots from the macro strategy to actionable trade ideas. And that's what made the success of JDI Research for the past 5 years now, and give us one of the highest hit ratio in the research industry.
Reviewing 2019.
Really, it started in 2018, mid-2018. We started to recommend short inflation break-evens. And then from December last year, long 5-year bonds. And there was two main reasons for that, which were not linked to China. Firstly, I think that quantitative tightening directly feeds through lower global liquidity and naturally slower global activity. And that's exactly what happened this year. And it was very easy to actually forecast. And the second thing is that the Fed's really kind of tripped into the trap that Trump put last year by increasing the real equilibrium rate, but only temporarily. And what's really interesting is that the Fed actually at the time did totally to take on board that real equilibrium rate was higher, and they went into calling it short-term equilibrium rate. What's interesting is that in 2019, the concept of short-term equilibrium rate totally disappeared. So you had basically Fed hiking into a rising equilibrium rate of, I would say, 1%. In 2018, which basically dropped to zero by the mid of this year, just on growth converging to its potential, which I see around 1.7 to 1.8%. The problem is the Fed forgot that it was a real a short-term equilibrium, and they were late to cut again. So that really fed through my view that the Fed was going to start cutting from mid 2019, and that's exactly what happened. But now we've talked about the past. I think no one is sitting in front of their screen to talk about the past. So what I would like to discuss is really what's happened this summer. I think what happened this summer is that we got into a vicious cycle where lower rates actually were calling for lower rates, even lower rates. And the reason is that we look at macroeconomic models assuming that human behavior will be rational. And the rational idea when you have forward guidance and central banks telling you that rates are soon going to be zero or even negative, the rational behavior, at least in Europe, is to basically jump at the last opportunity to get a positive yield. The issue with that is you get rational individuals turning into irrational collective behavior. So that means instead of having a model where low rates mean higher investment and lower saving, higher spending, you actually get people like you and me thinking, what am I going to retire on if I can't get any returns on my retirement funds? And you just save more. And, I've seen it. I don't know if you've seen it as well, but clearly that's something that you can see on charts and something that's actually turned. And I actually think that we've reached the reversal rate in Europe about 3 years ago and in Japan about 5 years ago. What that means is you've got real rates becoming lower rates, negative rates, actually becoming contractionary. So the more you lower rates and the more you need to lower rates. And that basically causes the explosion in negative yielding debt that we've seen over the summer. That's basically what's happening in Europe, where negative yields actually become contractionary. But what it does in the US as well is that it spreads like fire. It spreads into a more inverted curve, and that can in itself, as we both know, be self-fulfilling and lead to recession. And that's very much what happened this summer, the sort of like groupthink, irrational collective thinking.
What changed your outlook?
The way I started thinking is when I heard Kansas City Fed George welcoming fellow central bankers in Jackson Hole, saying, "Don't feed the bears." And that's exactly what the way I'm thinking at the moment. If you basically keep cutting because markets demand cuts, and that's what the ECB has been doing, and it's in itself very detrimental, not only to investment, but also to demand, then you're basically feeding the bears. So what's needed in an effective liquidity trap is government spending to basically offset private saving to effectively allow the global saving gluts to be offset. And the interesting part, especially in Europe, is that also the debt to the GDP ratio have exploded since the last global financial crisis by about like 15 to 20%. Actually, the interest expenditure as percentage of GDP has absolutely collapsed to an all-time low. And that's really interesting, especially in the context of Mrs. Lagarde now taking over the ECB arm. Actually, the IMF just put out a paper reviewing what's happened with NIRP and the fact that they were also advising fiscal austerity at the same time. And they've been arguing that, clearly it was wrong. And that you can't just have like monetary policy. You also need fiscal policy. Otherwise, it's just completely counterproductive. So what I'm thinking is it's very much what's happening at the moment. There is really realization that debt to GDP ratio are becoming quite irrelevant if you can fund negatively. So you've got the French looking to cut taxes for the lower middle class by like 9 billion already next year. The Germans are looking to like do a climate saving program. The Dutch are also looking at the investment program. And, more importantly as well, French and Italian governments are now back in love. And I think that can really lead us towards more fiscal policy, especially with Lagarde having the political clout to properly explain why and how this needs to happen. Another thing that is really interesting on that side is that the Germans might not like spending, but what they hate even more is negative yields. And I think that is thinking that is really spreading in the rest of Europe as well. And that's really the main problem.
Is the ECB more important to global yields than the Fed?
So that's a really great question because for the first time, as far as I can remember, I actually think the Fed is much less important in terms of like global driving global yields. What we've really had and what I thought would happen, so we knew two things. Firstly, that NIRP is not working. And secondly, that sentiment is spreading on the fact that it is not working. And it's quite a big U-turn this summer because just before Sintra in June, there was an ECB paper looking at the fact that negative interest rates were still working. The reason is that the central bank was looking before at the supply side of credit. What I mean by the supply side is like, are banks still lending? And because banks were still lending, they were just assuming that everything is fine. But obviously, they failed to really look at the demand side of credit, which is that you and me are saving much more, which means that their models are broken. And the second thing to look at as well is like all these insurance, pensions, and et cetera. As far as yields continue to go down and you can keep like getting a capital appreciation, everything is fine. But when you not getting capital appreciation anymore when we stall, you're basically left with negative yielding assets, and that's an even bigger problem. So I knew on one side that there would be a U-turn in terms of thinking that monetary on its policy on its own can be potent. So I strongly believe that monetary policy needs to work in cooperation with fiscal policy, and that's something that I'm not on my own, thinking about at the moment. And the second thing I knew was that we were pricing 42 basis points of cuts at the end of August on the EONIA curve. So we were basically pricing that lower rates forever were going to be the answer to the next downturn, which I thought was completely wrong. So what I recommended at the end of August was to get out of long fixed income and look to start selling bubbles. So Germany 5-year at minus 93 basis points. And what I knew as well was that a lot of the US curve as well was the 1.43 print in a 10-year yield in the US wasn't due to escalation of the China versus US conflict. It was, in my mind, mainly driven by expectation of the bazooka that Draghi was gonna come for in September. So for me, that was the kind of mind-blowing risk-reward trade, where on one side that the ECB is not gonna respond like markets expect them to respond, and that it will basically drive rates everywhere else in the world. And I think that's really what happened. What we've seen is a decompression of term premia. Just on the basis of okay, we're done with the vicious cycle of lower rates, calling for lower rates, and now we're going to look for something different. And suddenly, we don't really know what that different thing is going to be, but what we do know is that the dispersion of risk is not one way, as we saw it was in August. And I think that was really the game changer in terms of monetary policy.
Why is recession more likely than reflation?
Sometimes, a trade that is just a great risk reward because you can see a different dispersion of risk than what market is pricing, which is really how the trade started at the end of August in short bubbles. Sometimes this trade, which is initially completely tactical, can become a bit more strategic. And I'm not calling for a global boom. Clearly, that's not my point. But what I do think is that we had a few other game changers in September that were not all linked to monetary policy. So the first thing maybe would be Brexit. So I think there was a game changer in September with Brexit, with Boris Johnson losing his majority in Parliament by more than 40 MPs. Suddenly, the DUP wasn't the kingmaker anymore. And that's a big deal, because it means that a potential deal with Europe can involve a Northern Ireland only backstop, whether it is by having agriculture deal or something like that. But that would also allow Boris to basically go with the Canada style agreement that he's been looking for. The second thing is that the Lib Dems have been going, basically we want to remain. If there is a general election and we win, we want to remain, and we're going to call off Article 50. That's a big deal for Labour, because that means that if there's a general election before UK is out of the EU, Lib Dem becomes kind of irrelevant. But if it's after, it's Labour that is becoming irrelevant. So I think that's a game changer in terms of getting Labour MPs to basically vote for the deal eventually, because they won the election after being out of the EU. Well, that's two things. And the third thing is probably that the Macron and Merkel definitely want to get done with Brexit. I think Macron doesn't want the second part of his mandate to be all about Brexit. He wants to be the post-Merkel who is basically leading Europe to different macro policy, whether it's fiscal and obviously in very close contact with Mrs. Lagarde as well. So that's for Brexit. I see basically much higher chance than we had in August of soft Brexit on 31st of October. That's obviously really important for Europe. The second really important game changer, which very few are talking about, is that the same reason I was calling for US yields to go down from December last year because of global tightening and the fact that US monetary policy was too tight for the rest of the world. Well, suddenly we've seen like US ISM collapse and effectively like converge to global PMIs. And I think a lot of traders, portfolio managers saw like the below 50 print in ISM manufacturing as a, that's it, like recession is coming. Actually, I thought, brilliant, because US is converging to the rest of the world. That means we're gonna have a global policy, which is gonna be much more appropriate for the world. If you look at a chart that I really love to look at, you actually, and that you're going to be showing on screen, you can actually see that the mini cycles that we've seen for the past 5-6 years have been driven by the differential of activity between the US and the rest of the world. Meaning when the US does well, it plunges the rest of the world into a slowdown because the Fed has too high rates. And obviously like 80% of global transactions are still in dollars. So that's the other game changer, that basically US is converging to the rest of the world, which means like the Fed, given the Fed is going to be just doing what markets are pricing, that means monetary policy, global monetary policy is going to become appropriate. And the third game changer, which I identified after the Biarritz G7, is that clearly, initially I thought it was just Trump who just would be taking a much softer stance with China, but it appears that China is willing to play game as well. And I think something happened after that Friday. Where there was huge escalation, and in my head it was really capitulation. Then the G7 happened, and we got the like 2% down in stocks, and suddenly like Trump came out and like I got a call from China. I think what's really clear is that the US main weakness is its financialization. Meaning the economy is going to be extremely linked with the stock market, and that means if you get like 5% downside in stock markets, the economy is not going to be as resilient as it was last year, especially given Trump can't come out with another fiscal plan before the next election. So that really just told me that, as a deal maker, it would make a lot more sense to get a much softer tone. And I think that's really what happened. And I'm not saying there's going to be a great deal. I think it's just going to be a cosmetic deal. But really what's important is we don't get escalation. So that's 3 game changes following a major game changer, which was the fact that the ECB wasn't looking to keep digging a hole for itself, if you prefer.
What does central bank policy convergence mean for markets?
So firstly, on the ECB, I was actually amazed to see my view completely validated so quickly. I actually thought it was going to be like a Draghi kind of, not saying too much, and then Lagarde coming out with, look, monetary policy is not really working anymore. At the minimum, we need cooperation. But actually, Draghi just came out, and suddenly, it was not about monetary anymore. Every single question was about just spend more money. So that was really the interesting part. And also to the question about whether we had hit the reversal rate, he was much less optimistic than he was in June, and saying like clearly it was going to be something that would be discussed in the future. Also, obviously, the QE infinity is an enabler for more fiscal policy. It's kind of giving a white card to government to spend. And so I think the message from the ECB was extremely clear. And I didn't expect that it would be so clear.
What indicators should investors pay attention to now?
I mean, if you look at what's happened in the US, for example, the cyclical versus defensive move has been completely in line with the repricing of the Fed. So I think we've priced out like 30 40 basis points. That's exactly in line with a rebound in cyclicals versus defensive. And that's a chart I love to look at in terms of figuring out whether it's going to be a shock, a yield shock, and like a mini tantrum, or whether it's like a positive thing. And so that's really telling me that it's a positive thing. Obviously, European stocks have been trading really well since the ECB, and that's been led by banks, which is the interesting thing as well. I think talking about the dollar and euro dollar, the interesting thing is that it puts less pressure on the Fed to like deliver like immediate cuts. Because if the ECB is not cutting anymore, not digging its all anymore, then suddenly you get some support for euro versus dollar, which means like, okay, the Fed is still relatively quite hawkish, and the dollar is supported, but it's not making new highs. And I think that's really what we've seen in September.
How should investors trade fixed income and equities?
So what I've been recommending since end of August was short Germany 5-year. I got out of long US as well. I'm feeling very bullish European stocks. I think they're cheap. They're very leveraged to the global cycle, which I think was too bent towards like imminent recession. I think there's a possibility that we have another mini cycle. I don't see huge vulnerabilities, whether in the US or in Europe, or at least not as much as what the market chatter is about. So I like European stocks. I like short bonds in Europe. I think one of the themes that's going to be really interesting is monetary policy in the US, where it's easier to sustain the priced cuts than obviously in Europe. So we're going to have Europe doing fiscal versus US doing monetary. And I think that's going to keep the dollar from strengthening much. I think that will keep euro supported and eventually means a higher euro. But I don't think that's an imminent story. I'm looking, I think, in terms of US fixed income, I think we've probably done 75% of the move in terms of decompressing premia. I would be looking to re-enter 10-year yields closer to like 2% and to basically run the trade short bubbles versus long US. I think that could be something that really starts trending into next year.
What is the potential for global yield convergence?
Well, we've literally seen almost nothing now so far in terms of convergence, because it was really the first part of the move was like term premium decompression. And in fact, I think the US has moved more than Europe since the beginning of September. I'm not exactly sure about that, but I think it has. But I think that's the first step. And I think the second step is basically US is still, there's no imminent recession, but we're still going to be like slowing down. I don't have any question about that. I think probably we're currently around like zero in terms of real yields. I think probably equilibrium would be a bit negative. So I'm still looking for like another cut at least this year. So that really, I think, should fit through the kind of like new theme, which is Europe fiscal versus US monetary.
What happens to the yield curve?
I would be looking for steepening there. I think we're still pricing too much negativeness around Europe. If you really look at what's happened in Europe, the interesting thing is that a lot of the weakness has been completely driven by Germany and Germany manufacturing. The thing there is that Germany has by far the largest fiscal space. I think in Germany you could basically run deficits of like 2% per year and still keep your debt ratio stable. So that's almost like a no-brainer. If you start seeing employment going down in Germany or unemployment going up, I think straight away you can resort to fiscal policy. And if you look at the services sector in Europe, everywhere it's actually been trending up for the past 6 months. So we've had a little bit of like a coming down at the beginning of the year, which was totally making sense. But we've actually been trending up in services. And I know there's a lot of like the narrative that manufacturing always leads services, but this time it's not. I think we've got the biggest like divergence. I don't have the chart like in front of me, but I think we've got a very large divergence, which is sort of like unprecedented in terms of how long we take to like reconverge. And I think it could be well explained by the fact that everything is like based around China and the trade war and manufacturing. But right now it's clearly not spreading.
How important is China to the reflation story?
You know what? I think China is trying to join the reflation party, but not to benefit the rest of the world. So I still don't think that we're going to see the same sort of like a big upturn that we've seen in 2016, 17, or even like 2009. We're not there at all. But what's happened in China is, firstly, the leading indicators have like picked up 6 months ago, and they tend to be like 6 months leading. So we actually, and also in September, which was another like a fourth game changer, maybe, is they've really joined fiscal to monetary as well by like accelerating the RRR cuts and really moving forward the investment quota. So I think China is not going to be having a big rebound, and especially not for the rest of the world, because I think they really want to be focused on domestic consumption. But what I think as well is we could be stabilizing as well there. So meaning, we're not going to get a big rebound, but we're not going to see anything much worse.
What happens to bond yields and inflation?
I would not rule like inflation out, like especially not in the US. And what I thought, and I've been like always like a deflationary. I've been like recommending like short inflation for the past, I think a number of years. But what's really interesting in the US is that Powell yesterday was like still absolutely talking about like muted inflation, really worried about that when, we now have like core CPI running on an annualized basis as 3.4. So that's nothing to be like, another Fed would have been starting to be a little bit worried about that, especially given, the consumer is really driving inflation. So of course that could just be temporary, but I wouldn't totally rule out like a bit more of an inflation burst in the US. And I think it's a good thing that the Fed is going slowly, because the risk would be that suddenly the curve steepens, and that would be the real risk to assets, like financial assets, and eventually like a recession risk. So I can see reason why you wouldn't go like and like cut 50 and like steepen the curve, weaken the dollar. You might lose control of a little bit control of inflation and eventually like steepen the curve and basically crash assets.
What will reflation policies look like, and when might they take hold?
It could take a long time, but it could get priced quickly. So we're in the middle of like budgets at the moment in Europe. No one is going crazy for sure, but I think there is a move to like simplify the fiscal rules in EU. So that's one important thing. Looking towards more of in the future, I think what we could have is like Lagarde has been talking about central bank issued digital currency. And when it was first floated, the idea like 2 years ago, the idea was that, you and me would have money at the central banks. And so I'm not talking about Bitcoin or anything. I'm just talking about you and me having money at the central banks at a public entity instead of a private entity. And what they were thinking at the time is that they could basically cut rates as far as they wanted because they don't have the same constraints as a bank. I think that idea is completely gone now because of what we explained before, that it would be totally contractionary. But the way you could use it is basically by doing people QE. And that's one thing that was actually mentioned in Draghi's press conference. And he did say that it would be something that would be part of a strategic review when Lagarde comes in place. So that's an interesting thing. Then you're just talking about like different countries, different policies, but in Japan, you could easily have like monetization. Basically, monetization is like debt financed by QE, which is very much already possible, but like that Japan is not using. It might sound like really controversial, but actually it was very widely used before the 80s. Like it's been used in France, Italy, UK, and Sweden. So it's not really that controversial. It's just that then we got inflation going out of control, and we went into the 80s. Really wanted like central banks to be independent and with a strong inflation mandate. But that's like the different forms that we could be thinking about, like people QE, monetization. You could have like governments having an account at the central banks as well, which makes the whole fiscal program much more nimble and much more, in terms of like moving markets expectation, much more transparent. Because the problem at the moment is like, everybody is asking, but what are they going to do? And when are we going to know it? And, but the Germans, they still want to spend. And what's that program? What is it going to do? Like climate change program? What exactly does it mean? And I think if you had like basically a government account that can be basically filled by the central bank, which also means that the central bank's not losing its independence, then suddenly we'd be like, okay, we can see it. Maybe recession is not tomorrow.
Can you summarize your view?
Well, I think we are a really interesting crossroad, whether it's Brexit, whether it's China, US, the US election, the ECB and the sea change in monetary policy. And, I would urge you to call me and navigate those rough waters together in the future.